All right, cool. What's good, guys, and welcome back to another video. So in today's video, we're gonna go over risk management, understanding what is risk management, how to use it with trading. Risk management plays a big role in trading, right? I can teach you guys how to be a day trader. I can teach you guys how to trade fundamental and technical, but all of that will be useless if you guys don't understand what is risk management. Again, risk management does play a big role in trading. So make sure you guys take a lot of note. Make sure you guys do understand every single thing that we're going to be speaking about. Again, if you guys don't really understand anything, you guys can rewatch the video over and over again till you guys master it, until you guys get it clicked into your head, right? Again, you guys can always comment down below any questions that you guys have. So let's get started. All right, so risk management in day trading. What is risk management? So risk management is the practice of controlling how much money you could lose on each trade. It helps you protect your account from large losses, making sure that even if some trade doesn't go well, you can keep trading and not wipe out your whole entire account, right? So the goal with risk management and in day trading, right, your goal is to only risk only a small amount of your account. It can be your capital and it can also be profits on each trade. Now, I do recommend you guys to always risk 0.5, right, to 2% of your account balance. This is where I want you guys to pretty much focus on. Just risk this much of your account balance. So let's say you guys have a balance of $1,000, right, of 1K. You guys are only gonna risk 0.5 up to 2% of your account balance, right? Later on, I'm gonna give you guys the risk management plan that I use and how to properly use it correctly, right? This is the risk management plan that has been working for me for the past years. Same exact risk management plan that I continue using, which I'm gonna show you guys later on in this video. Now, why is risk management important? Again, like I said earlier, it helps you protect your account from large losses. Risk management is important because it helps you from losing too much money on a single trade. So without it, right, a few bad trades can actually hurt your account. Pretty much it can wipe out your account. You guys can lose the account and you guys have to start all over again. So having a risk management plan, right, helps you from losing small, and you can obviously continue trading and grow your account over time. And the most important part, right, is that it keeps you around this game, right? So it keeps you alive in this game, which is obviously going to give you guys the option to continue growing your account and making more money, right? So again, if you guys have a 1K account or any other account, right, I do recommend you guys to only risk this much of percentage. We go to the next one, how to use risk management in a trade. So risk per trade. Decide of how much money of your account you're willing to risk on each trade. Again, I told you guys to risk either between 0.5 to 2%. So if you risk 1% of your account balance on each trade, for example, if you have a $10,000 in your account and you will only risk $100, right, on each trade. That means that if the trade goes against you, if it hits your stop loss, you only lose $100 and nothing else more, right? So let me give you guys a quick example. Let's say you guys enter a buy position, right? You guys enter buy position, price starts heading to the upside, but then reverses and takes you out of stop loss, right? Once it takes you out of stop loss, right, that means that you're out of the trade. You lose only $100 if you're risking 1%, right? If you're risking 0.5, you lose 50 bucks. If you risk 2%, you lose 200 bucks, right? So position size. Position size is pretty much figuring out how much unit you should trade based on your account that you're willing to risk, right? The units, we're going to use it as a lot size, right? What lot size are you guys are going to enter the market with, right? Is to calculate it, right? To calculate it, I use a website that is called My FX Book Calculator, which I'm going to go later on to show you guys how to use it. But again, it's just going to show you guys what lot size to use. Either you guys are going to use a 0.10, a 1 lot size, or a 2 lot size. It really depends on your account balance, right? This is the one that I use every single day before entering a trade, because using the right lot size, right, is going to give you guys obviously what you guys are going to risk. So let's say that you are using a 20 pip stop loss, right? And then you have an account of $10,000 and you're only risking 1%. For example, this is going to tell you guys, okay, you're using a 20 pip stop loss, you can use a 0.63 lot size. If the trade does goes against you, then you're only gonna lose $100, right? Now with the stop loss, right? Something that I do get asked a lot, right? Because there is gonna be some trades that obviously you're gonna have to use a little wider stop loss to give the space, right? The bigger the stop loss, it does not mean, right, that you're gonna lose more money. If you're risking 1%, every single stop loss is gonna count as 1%, right? It doesn't matter if your stop loss is 40 pips, 50 pips, 80 pips, even 100 pips. If you're risking 1%, it's always going to lose $100. Now, the thing about using wider stop loss, right, is obviously just the risk to reward. You have to look for setup that if it does require higher stop loss, then obviously you guys got to use a really good risk to reward to obviously make double of what you're risking, right? Which we're going to go into here next one. which is cutting losses early, right? So always use a stop loss when you enter a trade. If a price hits your stop loss, you have to exit out the trade without hesitation. So again, if it hits your stop loss is placed for a reason. It means that the trade did not go your way, you were wrong in the analysis, or maybe you have to re-enter the market later on if it gives you a good opportunity. But if it takes you out of stop loss, you're done, right? So cutting your losses early helps you prevent small losses from turning into big ones. So if, let's say you guys did not have a stop loss, right? This over here would have been $100, but let's say price continues heading to the downside and you're just moving your stop loss, right? The more that you move your stop loss and the more the price goes against you, the more money you're gonna lose. So let's say you would have lost $100 here, $200 there, $300 here, just because you thought that the market was gonna go do something like this and head your way. No, right? Something which I'm gonna go later on in the video, right? Which I'm gonna explain to you guys how I pretty much just manage my stop loss, how to cut early losses, and how to cut my losses early, and how do I trail my stop loss, which I'm gonna go later on in this video. But very quick to give you guys an idea, since right now we're talking about cutting losses early. Let's say that you guys are in a trade, right? And then price action starts going against you, which is over here. We're gonna speak about it right over here. If you set a stop loss of 50 pips and price moves against you 50 pips, you have to exit out the trade, right? This is from holding long position and losing more money. What I like to do though is that I cut my losses early. So let's say that we're risking 50 pips, right? Let's say we enter a buy position and then our stop loss is somewhere between over here. Let's say the price starts heading to the down upside and then it starts going against your trade. You're gonna start cutting your losses early. So let's say that you guys are using a one lot, right? If price starts going against you a little bit earlier, right, that means that you have to cut your losses early, not leave your loss running until it hits your stop loss, right? Because again, you can save more capital than actually losing the whole entire 1%. So if it starts going against you, you guys want to cut 50%, right? So if you guys are using a one lot size, 50% is obviously you're going to be 0.5. So you're going to cut down 0.5 of losses, right? Which you're going to lose $50. And then you're going to leave the other $50 pretty much just running. So if it goes against you, then you're out at $50, right? So pretty much you lose 100. I believe you lose a little bit less than $100, but at least you managed to cut your losses earlier, which you're not going to lose all the $100, right? If it starts heading back to your upside, then obviously the next thing you want to look for, in this case, we're in a buy position, then you simply want to wait for another break of structure. Oh, sorry. You guys want to wait for another break of structure and a proper entry. If it gives you proper entry, then you guys can go back and then risk another 0.5%. So you guys can be using back again a one lot size and then obviously have a stop loss between somewhere over here. So you guys can obviously capitalize with the market. Now, letting your winners run. This one is very important. This is where a lot of traders do fail, right? Because again, they don't cut their losses early thinking that price can actually reverse and hit their take profits. No, your goal as a trader is to protect your capital, right? So cutting your losses early is very important. And it's also very important to leave your runners running, right? So if your trade starts moving in your favor, you can adjust your stop loss to break even, right? So if you guys enter a buy position right over here, price starts heading to the upside, you guys want to place your stop loss at break even, right? If it places your stop loss at break even, which is going to be your entry point, right, it's going to take you out of win, right? So for example, if you start heading to the upside, place your stop loss at break even. If price reverse, you will lose $0, right? So exactly what it says over here. If the price move 50 pips in your favor, you can move your stop loss to break even. So if price reverses, you don't lose anything, right? So if you're 50 pips in profit, price comes back, takes you out of the trade, right, which is break even, then you don't risk anything, you don't lose anything, right? And pretty much you just simply wait for the next setup, right? If the price continues to move up, you can adjust your stop loss higher to protect your capital. So if you guys enter a buy position right over here, price starts heading back to the upside, right, and it's perfectly heading to your way, then what you guys want to do is just trail your stop loss a little bit higher. So if it does come back over here, let's say you were in profit over here, $100, and then over here you're up like around $300, right? But let's say price action does reverse, takes you out around profit, then you only win $100, which is better than obviously not losing, not even taking a trade or winning the trade, right? Which is just simply protecting your capital. Now, risk to reward. Try to have a good risk to reward ratio, such as a 1-to-2 or 1-to-3 risk to reward, right? This means to aim for something that is 2 or 3 times more of the account that you're risking, right? So if you're only risking $100, right, what is the 2 or 3 times more? So $100, right, you're only risking 100 to make $200 to $300, right? So for example, if you risk $100 in a trade, try to aim for $200, which is a 1-to-2, or $300, which is a $1-to-3 in profit, right? This helps you to ensure that even if some trades, few losing trades, right, even if you lose some trades, your winning trade can still make up for them, right? So an example of a good risk management plan. Your account balance is $10,000. Your risk per trade is 1%, which is $100. Your stop loss is 50 pips, right? 50 pips, 100 pips, 30 pips, 20 pips, you're risking 1%, you're always going to lose $100. Always try to look for risk to reward ratio out of 1 to 2 to 1 to 3 minimum, right? You guys never want to do a risk to reward which is 1 to 1. And I'm going to explain to you guys why. This one is very simple. You're risking $100, right, to make $100 back. Just think about it. You think you will invest in something that will give you what you invested in. So let's say you guys invest in a water bottle that is $1 and then you sell it for $1. You guys did not make any profit there. All right, you're basically back at break even. Your goal is to make double of what you're investing in, right? So again, you always want to look for a 2 to 3, 1 to 2 to 1 to 3 ratio. So position size, let's say you guys use a 0.10 lot size, for example, in the calculator above. In this example, you're going to risk $100 per trade with a 50 pip stop loss. If the trade goes your way, you aim for a profit of $200, which is a 1 to 2 risk to reward. By following this plan, even if you have some losing trade, it won't hurt your account too much and you will be in a good position to continue trading. If you only do this over here, obviously your account won't be profitable, right? You just continue winning the same, and if you lose, you're going to be losing pretty much more. Because let's say that you lose 2 trades in a row. Boom, you lose 2 trades in a row, you're back at, negative $200. So let's say you guys lost 101, $100, another 101, $100, you guys already down $200. But let's say you guys catch one trade, which is a 1 to 2, boom, you're back at break even. Let's say you guys catch another trade, a 1 to 2, boom, you're back at $200 in profit. And then again, if you lose a 1%, you're back at $100, right? If you guys win another 200, you're back at 300, right? There you go. This is a really good risk to reward ratio. Now, if you guys only risk $100 to make $100, check this out. You're only making $100, but if you lose the next trade, you're down 100. We'll pretty much break even. You lose another one, now you're down $100, and if you win another one, you're back at break even, right? So it's not really any profit going on over here. So you guys always want to focus on a 1 to 2 to a 1 to 3 risk to reward ratio. So the conclusion, right? So pretty much risk management, it's very important. I'm going to show you guys now the website that I use. I'm also going to show you guys the plan that I use on a daily basis so that you guys can start applying it into your own trading. So this is the website that I use, which is myfxbook.com. You guys are going to come in this website. You guys are going to click on the FX calculator. You guys are going to go to this one, which is a position size calculator, right? This website is completely free. You guys don't have to pay for anything. So position size, all right? Let me explain to you guys exactly how to use it. You guys look left, right? You have your currency pairs, your account currency, your account size, your risk ratio percentage, right? This is what you're risking, and then your stop loss. So let's say you guys are trading, let's say GBP, JPY. Let's say your account balance is at $5,000. Let's say you're risking 1% of your account balance. Let's say that your stop loss is at 50 pips. You calculate it. Boom, there you go. This is what you're risking. You're risking $50. This is the lot size that you guys are going to use. Now, what is the goal here? Your goal is to make double of $50 or double what you're risking. So if you're risking $50, your goal is to make either $100, $150, $200, $300 above, right? You guys don't want to be anywhere between $50. You guys always want to make more of what you're investing. Now, like I was saying earlier about stop loss, right? It doesn't really matter how big or how small your stop loss is. The only thing that's going to change is just your position size, right? So let's say that you guys are risking, let's say 100 pips, right? If you're risking 100 pips, you can't use the 0.15 lots because again, that's where you're going to lose more money. This is why it's very important to use this calculator size. You calculate it, you see your lot size goes down, but notice that your risk is always the same. You're always going to risk $50. Let's say that you're now doing a small stop loss, which is going to be at 10 pips. The thing that's going to change is just the lot size. Your calculator, boom, there you go. You're going to use a 0.76 lots. You're still risking $50, right? So obviously, the smaller the stop loss is, right, the better risk to ratio is, and the more money you're going to make due to the fact that you're obviously using a bigger lot size, right? But the risk is always the same, right? So the smaller the lot size, the more capitalized you're able to catch. The bigger the stop loss is, right? Nothing changes, right? Just the lot size amount and obviously the same. So if you're pretty much looking for a 1 to 2, if you're looking for a 1 to 2 risk to reward, risking $50, obviously you're going to make $100. Risking a 1 to 3, you're going to be making somewhere between the 150 to the $200. So it's very simple. So this is the system that we always use on a daily basis when we come to trading. So with proper risk management, right, obviously trading is not about trading every single day. It's not about how much money you can make every single day. It's looking for the best trades, the best setup that's going to give you guys obviously the high return, the high probability, then a lower probability. A thing that I like to use is that less is always going to be more. Right, so my goal when it comes to trading is that my goal is to make somewhere between 2 to 3% weekly and 8 to 10% monthly, right? So again, the goal is less is more. Our goal is to focus on less trade to make higher profit, less high risk to reward trade, right? So less risk, high reward. So if we look down over here, you guys can see this is pretty much the formula. You're only going to aim for 2 to 3% per week. So again, let's say that you guys have a $10,000 account. You guys are risking 1%. If you guys risk 1% of the account, right, you're risking $100, but your goal is to make somewhere between 2 to 3% every single week. So let's say you guys catch one trade, it gives you 2%. Boom, you're pretty much done for the day, for the week, and then you just move on to the next one. The goal is to obviously go anywhere between 8 to 10%, which is obviously going to give you guys a higher chance of making more money, right, in the long run than actually just trading every single day. Because again, let's say that one day you make 2%, but the next day you lose 1%. The next day you lose another 1%, and then it continues going on. You can either end the week at break even, or you can end the week with just either between 1%. So the goal is to always have less is more, right? So aim somewhere between 2 to 3% a week to make anywhere between 8 to 10% a month, right? So again, percentage can be used as well with the risk to reward. So a pretty much a 1 to 8 risk to reward in the whole entire week, or a 1 to 10 risk to reward in the whole entire week. So check this out, trade limit. Limit yourself to trade at least 1 to 2 trades per day, right? The main focus is to avoid over trading. Once your weekly profit is met, pretty much you stop trading for the week to protect the gains and avoid unnecessary risk. Again, your goal is just 2 to 3% a week to 8 to 10% every single month. So if you stick to this formula, right, achieving these small consistent gains will compound your account over time, leading to a long-term success. This is the website that I use, which is my FX book. Over here, I have an example to give you guys. So if you guys have a $10,000 account, right, because again, there is prop firms that do give you guys ability to trade on large amount of capital, which obviously it is the idea so that you guys can make good return of money, and then obviously continue compounding, put all of that into a live account and just continue making more money. But check this out, account size. Your weekly profit goal is 2 to 3% a week. So that means that your profit is between 200 to 300 bucks. If you guys look at the monthly profit, which is 8 to 10%, you're making between $800 to $1,000 every single month, which is great. We look at the $50,000 account size. Your goal is to make between 2 to 3%. So you're risking 1%, you're risking your 500 bucks to make 1,000 bucks to 1,500 bucks. Then your monthly profit is going to be between $4,000 to $5,000. If we look at a higher account, which is $100,000, your weekly profit goal is to make $2,000 to $3,000, and then your monthly goal is to make between $8,000 to $10,000. So here I have a formula for profit targets. Here's an example. So example of a $10,000 account at 2 to 3% every single week. 2% profits is going to be 200 bucks. 3% profit is going to be 300 bucks. The monthly 8% is going to be 800 bucks a month. 10% is going to be $1,000 a month, right? So your goal with trading is not rush. There's no rush at all, right? There's no rush to be placing trade every single day to make the most money. There's no such thing that the more that you spend time on the chart, the more that you spend trading, it's not going to make you more money. It's actually going to do the opposite. It can actually hurt your account. You're going to be over trading. That's where emotion comes. You're going to be over trading. Okay, damn, I wish I made more money today. Oh, I lost this much, but I'm going to continue making more money. It doesn't work like that. The goal is to be less is more. So the less trade you take, the more money you're going to make on the long run. And then if we look down over here, right, your trade management, you only want to look for at least 1 to 2 trades per day, only risking 0.5 to 1% risk. After each trade, right, your goal, well, this is pretty much just for the system for the VIP members. This is just what I do, the trade review, but I do recommend you guys to do it. After every single trade, your goal is to journal the trade. Why did I take this trade? Did it go my way? Why did I lose the trade? What could I avoid in this trade, right? So again, it's really, really important to create a trading plan. I do recommend you guys to take a look at this, and if it does, if you guys do like it, I definitely recommend you guys to follow it. That's pretty much it, guys, for today's video. In the next video, we're going to go over a trading plan, create and using a trading plan.